Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.
Dan Wilton is the CEO of First Mining Gold, and we're talking about the macroeconomic landscape as it affects the mining industry, both for the seniors and the juniors. Welcome to Kitco. Welcome back, Dan.
David, great to see you again. Great to see you in person. The last time we
Absolutely.
did this was virtual from my basement. So,
your basement was a good-looking basement, but this conference is a better-looking venue. No offense to your basement, and of course, it's better to do this in person. You and I have been talking offline about your developments, recent developments, and assessments. We'll be talking about your drill assessments in just a moment. I want to talk about what happened with the gold price in the last year and a half, and what's been happening with the gold industry in response to the gold price. So, what's your take on the current macroeconomic environment? People have been asking me personally why gold hasn't been trading up higher.
Yeah, I think we all look at the gold environment now, and it's a perfect storm that should be positive, right?
Yes.
Particularly with inflation, you saw out of the UK, headline inflation in excess of 9%. And we just haven't seen things like this for a generation. This is gold's moment to shine. And I think when you look at what's going on more broadly, some other asset classes, particularly kind of what's been happening with some of the cryptocurrencies, like it's starting to highlight, I think, the fact that gold has done its job. Right? We're entering this inflationary phase, and you've seen the gold price actually, up from where it was in 2019 at the 1,300 level. Now 1,800 has tested 2,000, 2,100 a couple of times. Those both on the back of, call it more macroeconomic calamity and potential, concern. But I think, for all that we're wringing our hands about an $1,800 gold price.
That's exactly my point. First of all, I've heard the viewpoint that we got to just zoom out. Look at a bigger picture chart here, Dan. I mean, not too long ago, we were still at 1,500.
Yeah.
And then back in 2015, it was low 1,000s.
Yeah.
Right? People were not talking about 1,800 gold back then. Maybe this is actually gold's fair value given current economic conditions. That's one school of thought. The other is that, look, miners don't need anything higher than $1,800 to perform really well from a cash flow perspective. I'm talking about the seniors, of course. Maybe we don't need higher prices. What do you think?
But I think you'll see them, right? I think you'll see them, this push down from the kind of 2,000 level down to 1,800. You've seen really strong resistance at 1,800 a couple of times. It's been tested. And I think, that profitability of the sector looks pretty good right now, but with labor cost increases, with input cost increases, capital cost increases, you're going to see that margin start eroding. I think that, that's what's going to, in some side, drive, supply response.
Yeah.
And it's going to drive, the gold price a little bit higher as it kind of sits. Like, if you think of it as a commodity, and gold's a terrible thing to talk about as a commodity, but sitting at kind of the 90th percentile of the cost curve is where you'd typically see over the long term, a tradable commodity trade. I think you're going to see that cost curve continue to creep up. So, but I think there's that. But I think right now this is sort of a consolidation phase ahead of the actual real response to inflation. Because it's only just really now entering the parlance of the, of the broader public, right? People have not been, those of us around the gold industry have been talking about inflation for a couple of years with, printing money and, the death of fiat and all the rest of that. But the reality is that's now catching up with the world. And you're starting to see it in things that move quickly, commodity prices, oil price, where you haven't seen it yet and where it's a lot harder to dial down. And we're seeing this in our business is on, labor cost inflation, what it costs to get people, what it costs to get contractors. Like that is where you're really going to see, I think, the inflation be a lot more difficult to rein in. And we are only a year into that. And you look at how those cycles have kind of run in the past of wage push inflation, like it only goes one way.
The mining industry is difficult in that sense because you can't just change the price of your goods to offset rising costs. Yeah. You're kind of fixed by the markets. Assuming a senior sells at the spot price and not a forward contract.
Yeah.
So
I think
how do people in your industry navigate rising costs?
Oh, you try and manage it. You start paying more close attention to cost profile and things that you're buying. But, just sourcing is difficult these days.
Let's talk about your company and how has your company been affected by 8% CPI in the U.S. Canada's rising as well.
Yeah, again, I think we're seeing it in costs of drill contractors. I think we're seeing it in costs of supplies. We're seeing it in cost of energy for our camp. Mm-hmm. We're not seeing 100% inflation in those things, but you're certainly starting to see it. And then in the sort of wages of people that we're hiring, you've seen it kind of continue to tick up at a pretty healthy pace. The other thing about this industry, that a lot of us sort of, if you're not working in the industry, don't really appreciate, is just the terrible demographics that you have in people who want to work in mining. It's really difficult to attract young people to come to work in the industry, and getting more and more difficult to attract people who want to go and work on a 2-week on, 2-week off rotation in a remote camp, right? Like it's that when the labor cost starts increasing and you start having inflationary expectations coming into the labor market, and it's already a super tight and constrained market like we have in a labor market in the mining industry, that gets hard. And I think we see it a little bit, but we don't employ that many people. But if you look at people operating remote mines, that's where you really are going to start seeing that cost.
Labor costs are probably the highest part of your SG&A for a miner like yourself, for an explorer?
Yeah, for an explorer, labor cost would be a significant part, and the rest would be derivatives thereof when you talk about drilling costs, for example, or what we need to supply a camp with to keep people there.
I guess some supplies costs are transitory in terms of their rise in price, but labor costs are a little bit more sticky. It
is always sticky upward for sure.
Yeah,
it only goes in one direction.
Okay, so you talked about how gold should be going higher. Do you have a specific value in mind that you think would be fair? Put it this way: the uranium industry needs a certain level to, I was just talking to a CEO of a uranium mining company, and he said that the uranium mining industry needs, I think, $75 right now before mining resumes in North America. We're nowhere near that. Uranium briefly touched $65 a pound. It's come back down to 48. But just for the gold industry, is a similar parallel? Can we draw a similar parallel in the sense that operations would be, I guess, more profitable, it would be more profitable, but operations would have higher levels of production, and the seniors would be more incentivized to increase their production at a higher rate if the price reached a certain threshold?
What's interesting about that question is, it makes an assumption that you are just able to increase your reserves, right?
Yes.
And that's one of the things about the gold industry, about the mining industry generally. People forget that those reserves sit in the ground, and sometimes there's some grade flexibility. Have a lower grade, you increase tons, you drop your cutoff grade, you can make things a bit bigger. There's a finite limit to that. But for new deposits, if it hasn't already been found, the process and time to go find and develop a big project in any kind of tier 1 jurisdiction, it's probably 15 years from the time that you have real exploration discovery to take it through permitting and get it into production. So there's no kind of quick response. And from that perspective, I think gold's at a price right now where we're starting to see people kind of question to a degree that incentive price. Because you've seen some of the projects that are in construction right now having big capex overruns. You're seeing it at Cote, you're seeing it at Magino, and that's starting to then basically have investors look at some of the projects like ours and say, oh, well, we're going to need a better than 20% IRR on this project on a forward gold price basis before we're going to commit capital to build it. So we're still a ways away from that. We're going through the environmental assessment process, but that's where, I think the great fallacy of this industry is that, you can put on another machine and just make more gold. Well, you can in a short period of time, but you're limited by your reserves, right?
Right.
And the industry has systematically underinvested in exploration and development from 2012 to 2021. You can't catch up that 10 years of underinvestment or disinvestment in some cases. You can't catch that up in 2 or 3 years of aggressive spend. It's something that takes a lot of time, not to mention that it's just that scarcity factor that you got to go further afield to find projects, and your probability of finding them is lower because the ones that are easy to find have been found. You know what I mean? So I think that's one of the great challenges for this industry that people aren't really talking about or thinking about is what is that growth profile for the larger mining companies?
People really talk about the downside of gold. I bring this up because everything seems to have no downside these days. Cryptos have been wiping out. Luna has been making news, for example, is this coin that's been wiped out. 99% of this market cap gone.
Yeah.
Bitcoin is down, I think, 56% from its highs.
Yeah.
Say what you will about gold. Maybe it's not up 10 times over the last 2 years, but it's not down 56% from its highs.
Yeah.
It's not wiped out 99% in the span of 48 hours.
Yeah.
That would be a great day, wouldn't it? Is there a floor? I've heard a bearish forecast of $1,000 an ounce, and before gold, bounces back up. That's his bearish forecast from an economist we've had on. All the sustaining costs for a lot of these miners are $1,025, $1,100.
Yeah.
I'm just wondering if gold could ever go back to its 2015 lows of low $1,000. It wouldn't make economic sense, would it?
No, I don't think so. The sort of gold price trajectory that I often look at, having been in this business for 30 years, financing and investing in and now developing gold projects. I always kind of think, I've seen a few cycles and I always kind of look peak to trough, right?
Okay.
And a good way to look at peak to trough in the last cycle was the trough in the early 2000s would have been a gold price of, 260, 265. Peak was 1900. Mm-hmm. So you talk about, what is that kind of multiple of return you can have over a cycle that really, really gets to that point of the incentive price. And what is, the price that's needed to bring new production on? In sort of, again, that 2002, 2003 to 2011 timeframe, that peak to the trough to peak was a 6x return, right? The trough of this cycle, 2015, was, call it 1,000, 1,050. Is there any reason why this isn't going to be, a 2, 3, 4, 5x, 6x peak to trough like we saw before?
Right.
But I think what reset the trough at 1,000 was really, again, going back to the cost curve. That's the 90th percentile of the global cost curve for producing gold.
Well, retail investors have been asking me, talking to me offline at the conference here. Suppose gold stays flat, like around $1,800. Suppose it doesn't move up. Suppose it doesn't go down. It just stays within a range for a couple of months, maybe for a couple of years.
Yeah.
Is it even still worth considering investing in the mining sector? In other words, is there upside in the mining space? Assuming that gold stays flat.
So I think absolutely is the short answer to that.
Okay.
And it just all depends on where you're looking in the mining sector, right? So and where your risk tolerance is.
Yeah.
If you don't have much risk tolerance, you want to be looking at physical. And you're not going to get a lot of return on it. But again, it's probably going to hold or protect downside versus other risk assets if we're going into a period of a little more economic calamity, you're going to see risk assets sell off.
That's
We've
right.
seen that in the last 3 weeks.
Yeah.
So if you have a little bit more tolerance for risk, but you're looking for cash flow, what a lot of people don't appreciate now is that the senior gold producers are trading at record levels of free cash flow yield. They have never generated free cash flow like this ever at any point in a gold cycle. And that's, because they most of them have, long-lived assets with all the capital sunk into it, and they're trying to manage their costs.
Sure.
But, you've seen margins over the last couple of years, which are starting to be eroded by cost inflation. But those margins have been at record levels. But unlike in the past, when the senior producers took a lot of that free cash flow, reinvested it in their development pipeline, they haven't done that in the last 10 years, by and large.
Yeah.
So that's the seniors therefore provide, I think, good free cash flow yield, and you buy it, you're going to buy,
And they're issuing dividends now?
starting to pay dividends, which again is taking capital out of the sector because those dividends don't necessarily get invested back in mining projects. But then you look at the rest of the sector and kind of where we are in the development space, absolutely unloved. And it has not been this unloved since 2015. probably, which was coincidentally the time that Keith Neumeyer founded First Mining Gold to go buy undervalued assets. Well, everything that's kind of back down to 2015 valuation levels. So I think at an $1,800 gold price, and just to give you a sense, our pre-feasibility study on our Springpole project, which we did last year, had a just shy of $1 billion US NPV at $1,600 gold, and an extra $150 million of after-tax NPV for every $100 increase in the gold price. So at $1,800, that's $1.3 billion, right? We're trading at a market cap today of 170 million Canadian.
Yeah.
So 1.3 billion, you know, that's you're basically talking about a 10x just in return of us moving the project forward to surface that value, taking it through permitting, getting our feasibility study done. Now, there's been some cost inflation. We're going to see that reflect in, you know, studies as we move forward. But fundamentally, when you can buy these projects like ours at $10 an ounce in the ground, and you know that when it's permitted, they usually sell to bigger companies at $100 an ounce in the ground, and you can look at like, you know, 20 years of comparables that will tell you that's what it looks like.
Yeah.
You know, there's real opportunity there just in asset selection. When I was an investor, I used to call that was your alpha was in asset selection. Right. Just in asset selection, finding good projects, you can still see multiple returns on your money.
Can the seniors afford to buy projects right now is my question. You mentioned that their cash flows are a record. Yeah. That is true. I'm just looking at theirs, for example. How the 2021 free cash flow did drop significantly from the 2020 levels, and that's due to a number of factors, mostly because of inflation, like you said. Yeah. They're probably worried about containing their own costs, not concerned about shopping for new projects. I'm just making that assumption. Am I wrong?
I think everyone is looking. Right.
Okay.
I think everyone has to look because, and honestly, it started, David, interestingly, I'd say in 2020, when people kind of came out of COVID lockdowns. Yeah. And for the first time in 9 years, the corporate development guys had a budget to go look at projects. Right. Because they didn't have a budget to do it from, 2013 to 2019. So they kind of started looking, and it was about the time we were working up our pre-feasibility study. We put ours out in early 2021, and lots of interest from the industry and people just kind of coming around to understand it. And why? It's pretty simple, because there are very few 5 million ounce plus projects in tier 1 jurisdictions that you can scope as building for less than $1 billion. So for a Barrick, a Newmont, an Agnico, a Kinross, you can step into something today to buy resource, if you were actually in the business of buying resource with a bit of risk on it, which most of them aren't. But you can and make exceptional returns on that because you don't have to pay that $100 an ounce in the ground. You can invest in, or which you used to see a lot more of, large companies making strategic investments in project developers and, kind of working along the path with them. You don't see that as much anymore. It's starting a little bit more. But now, can they afford to do it? Absolutely. Not only can they afford to do it, their share prices, because a lot of these things you could acquire for shares, their share prices, these would be phenomenally accretive acquisitions when we're trading at, 0.1 times NAV, and your average producer trades at 1.6 times NAV, right?
What is the typical M&A cycle? Do people buy when the gold price is high or low? I mean, there does seem to be more M&A activity when the gold price rises.
Of course.
Which is kind of counterintuitive to me.
It's pro-cyclical investing, right? And the challenge is this industry has always had a real drive to pro-cyclical investing. I.e., gold price is high, so we're making a lot of cash, so we should take our cash and go buy projects. And then projects get a bit of a scarcity value to them. Yeah. And then from that scarcity value comes some of the kind of irrational competitive tension that can drive prices.
I'm just saying, if I were a major shareholder, I would say to Newmont, what are you doing? Why don't you buy when the price is $1,500? Why don't you save some cash now when prices are high? But
yes,
I mean,
a lot of people would say that, but the big companies trying to court generalist investors, have been saying, oh well, we're capital disciplined, we're returning capital to the shareholders, and we have enough to fund our own, pipelines, and we have enough for reinvestment. Don't worry. Yeah. But the reality is, every dollar that they're sending out to the shareholders is a dollar they could be using to augment their own pipelines, right? And they just they've been doing it in a slow fashion, a little deal here, a little deal there. Yeah. But eventually this is going to become it's a game of musical chairs.
Yes.
And this is what we saw in 2010, 2011. I was a corporate finance professional at the time, and we shot the lights out for 2 years because that scarcity value of the projects became real. And so all of a sudden, companies get rewarded for pipeline when no one has pipeline to develop. So you trade at a 1.9 times multiple because you have these next 2 mines that you can build in the portfolio, and the guy who's just three mine mining company that doesn't have that growth profile, they trade at a much lower multiple. So then they figure they're going to get rewarded for growth, but the gold industry has not been rewarded for growth at all since 2011. Basically, that will change. It has to change.
It's not been rewarded for growth. What do you mean by that?
Meaning that there hasn't, all the focus in 2011, 2012 through 2019 was cost containment.
Yeah.
And driving capital efficiency.
Right.
And then from 2019 to today, it's been on returning capital. It hasn't been on growth. There isn't a higher growth senior gold company that trades at a premium.
Well, do you think the objectives of growth for a senior miner has changed over the last decade? Do you think that maybe now there is a higher priority in developing projects, new projects in-house, exploring in-house, rather than acquiring greenfield exploration projects? What do you think?
There is. You're starting to see some of that change. You're starting to see, Barrick's making a big push into Canada, for example, and happens to be in our neighborhood.
Let's talk about that.
We're pretty happy about that. No, they've optioned into 3 projects, right in northwestern Ontario, one of which is literally on our southern flank. But they're starting the push that, there's nothing that they see that they would want to buy as a producing mine, and they're very capital disciplined. And so, but we want to be in Canada, so we're going to start. It's a long road. As I said before, if they had a world-class discovery there, which probably takes anyone 3 to 5 years of work to really, tag into something you can define as a world-class discovery, from that point, it's probably going to take you 12 to 15 years to build a mine. It's an important part of the strategy, and if you have the free cash flow of a Barrick, you can afford that long-dated investment. But you've got all these mines with near mine opportunities, some of the things you have in-house. You have this long-dated pipeline that you can build through your own exploration. And listen, seniors gave up greenfields exploration a long time ago because they came to realize that why would they commit the capital on a limited subset of opportunities when they can watch the entire market and have project developers and explorers take all the risk, and then they invest when they know that they have something, right? Yes. So I think that's changing a little bit, but that's not going to change in time to have your current reserve base start to really decline.
Well, one fact that you gave me offline that I found interesting was that, yes, the mining industry has, the valuations have all gone down because of where equities have gone and because of how flat gold has been.
Yeah.
Juniors a little bit more than the seniors, of course, because of the higher beta. But you mentioned that the valuation gap between the juniors and the seniors is now the highest level since 30 years ago.
It's something I would need to, go back to look at the real data before I say the highest.
But it's been very high.
Unquestioningly, this is as great a gap as I can ever think about seeing in 30 years. And it has everything to do with the fact that, developers are all kind of being abandoned because of fears of capital cost and permitting time and everything else. Like established resources, we've got 8 million ounces of gold in First Mining Gold, trading at $10 an ounce. And we're not alone. There's a lot of companies, but even the more advanced stage developers about to start construction, some of them are down 40 and 50% this year. The seniors are down 10, 15, Right. So that just even in the last 6 months, the gap was already pretty big, but in the last 6 months, that gap has gotten enormous.
This must be good news for potential M&A activity. I'm just looking at relative valuation and the relative NAV values. I mean, this must be, if I were a senior, I'm looking at your share price and I'm thinking, wow, that seems to be a bargain.
Yeah, I guess.
If this is good for an equity deal.
Part of it comes down to, what's the real risk when you're investing at such a low price. But part of it, from our perspective, then the challenge becomes, you don't want to sell a project at $10 an ounce, right? We still see that opportunity with the money that we have in the bank and the talent that we have on the team, we see the opportunity to get this project to serious de-risking milestones in a 2-year time frame, right? So maybe you look at bringing in a partner as a strategic investor, that you get some of that external stamp of credibility and guidance. That's something that we've been reasonably, public about talking about that we'd be open to. But it kind of keeps you up a little bit at night that if someone really likes the project, your shareholders would need to have a lot of conviction, because that can kind of spiral, into a process out of your control pretty quickly. And you take some comfort in the fact that, the closest parallel to that, you look at the nickel projects in the Ring of Fire with Noront. It sort of trading at a very low level, found someone who wanted to acquire it. There was someone else who wanted to acquire it. And the ultimate price between two informed bidders ended up being whatever, 300 or 400% above the starting point, right?
Yeah.
So if there are enough people interested, the market will find the fair value. But it's making sure that, you've had enough people who've come and had a look at your project and understand it. And, in a perfect world, you have someone kind of walk along the path with you.
Well, tell us about your next steps. Tell us about your recent drilling activity and finally your 5-year, maybe perhaps 10-year plan.
Yeah.
Are you thinking of going into production yourself, or is your ultimate goal to be acquired?
Always a great question. We faced that a long time. And the answer to that last part of the question is, we're going to do the right thing for the shareholders, right? And I've been through enough of this in my career as an advisor and as an investor to know that your only path is to make sure that you have as many options open as possible when you get to that point of de-risking and that point of that construction decision, because it's a huge dilution event.
Let me just hypothetically, you're producing. Let's say you bring your mine into production. And I'm a Newmont or a Barrick, and I come to you and I say, Dan, I'd like to purchase your property. You say, we're already producing. At what multiple of your NAV do I have to offer you to incentivize you to stop producing?
Well, it wouldn't incentivize us to stop producing. It'd incentivize us to sell the product. That's there's a lot of water to go under the bridge before we're in a position to answer that. And again, the answer is always, what are the alternatives, right?
Yeah.
And so, but the big sort of turning point is that construction decision. Because we've seen it's a real challenge for smaller companies to build billion-dollar projects. So as we think broadly about that, we have everything we need to do to get to that construction decision, right? On the team and on the capital that we have. So we're very confident on that front. And then it's about, do you look for a partner? Is the financial market such that, you have the ability to raise that capital and build it ourselves? Our new COO has just joined us a couple of months ago, Jeff Reinson, has built a lot of, billion-dollar plus projects inside big mining companies. So, I think there's nothing about building Springpole that he finds daunting. So, I think you can build the team. You need to build the team, obviously, to do that, but you can do that. You just got to get it to that point of de-risking and then assess what all of those options are at the time.
Finally, let's update us on your latest drilling.
On the progress. So most of the work that we were doing at Springpole this year was focused on feasibility kind of de-risking. So we did have 4 drills, mostly drilling on the ice to collect geotechnical data, to collect hydrogeological data, and really going in support of the feasibility and in support of the environmental assessment. So we've now got a draft environmental assessment largely complete. We're hopeful that we're going to put that up on our website and share that with the public. It's a 10,000-page document that's the result of 10 years of work. Share that with the public. And I think where people have some concerns about, the Springpole deposit's under a lake, you're never going to be able to do it. I think if anyone's going to read this 10,000-page environmental report and then have, justified questions and challenges there that they think that we're not going to be able to do it, then I'll have that conversation. But when you look at it, we're very confident of the technical capability of this to move forward.
Yeah.
There's still a lot of work for us to do with the indigenous communities in the area. We're hopeful to make very good progress there and, have some kind of green shoots coming on a path to move forward with our communities. But for us, it's really important that our communities have the real opportunity to understand and comment on this draft environmental assessment. So, so from there, we're literally going through this environmental assessment process. That environmental data will get shared with the regulators, and by the end of the year, we should have a pretty decent technical review done from, all branches of government that are going to look at it, that, we'll know if there's any showstoppers. But in the meantime, we're hopeful. We've brought on a new exploration team really over the last 6 months. It's getting very excited around our regional exploration package at Springpole. So we've almost doubled the size of our land package there over the last 18 months. 10 property deals that we had to do, but we've now largely consolidated the northern part of this Birch Uchi greenstone belt. We've got 5 permitted areas that we can drill this year. And starting really kind of from, foundational first principles in terms of collecting geophysical data and actually working up the district. So that's going to go on. And then on the other side, what a lot of people forget is that Springpole is not our only project, and we're making very good progress with the communities around our Cameron project, which is 80 kilometers north of Rainy River. And we're optimistic to get a drill program going at Cameron over the course of the summer, just waiting on some permits for that. We think we should have exploration results coming from both of those projects. But at Springpole in the regional district, this is an area that's really attracting a lot of attention.
Attracting Barrick's attention.
Well, they happen to have optioned into a project, 30,000 hectare project on our southern border. Yeah. So we're a lot more focus coming on the district. So I think there's lots of news to come in the back half of the year as we demonstrate that the 5 million ounces we have at Springpole is the starting point, not the end point.
We look forward to catching up with you again and providing more updates on your project. Thank you very much, Dan.
Thanks, David. Great to see you.
And thank you for watching Kitco News. I'm David Lin.
Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.